Hi, this is Jay Hummel. Welcome to the Deep Dive in partnership with Investopedia, coming to you to try to help you grow your practice and deliver better outcomes to your clients. We get a lot of questions. We are a viewer-led show, at least we try to be, and we're getting a lot of questions today about how do you think about a niche? How do you think about doing the right thing? How do you think about building a business that does more than just make money? And I couldn't think of a better guest to have than the founder and CEO of Zenith, Jason Ray. Jason, thanks so much for joining us on the show.
Absolutely, Jay. Thanks for having me. Excited to be here.
Well, man, it's awesome. And tell the viewers a little bit about you and a little bit about Zenith.
For sure. No, again, appreciate you having me on the show, Jay. I've been a big fan of yours and the podcast for a while. We met when I was working at Carnegie Wealth Management in Berwyn, Pennsylvania. About 4.5 years ago, I founded Zenith Wealth Partners. We are providing flexible advice to really address racial and gender-based wealth inequality. So we're tracking the wealth generated for our clients who are primarily people of color in the institutions that serve them. We just crossed 15 million in wealth generated for our clients, and the next stop is $1 billion. I grew up in Detroit, Michigan, but I live here in the Philadelphia area now, where I've been for about 10 years. And my partner Chelsea and I, who really was here since the jump to get this thing going and off the ground, oftentimes, look back and think like, wow, we've kind of led with intentionality and with our values and the things that we care about from the jump, and that's still really driving us today.
Man, it's fantastic. How did you get passionate about it? Obviously, we've talked about it a little bit, obviously, as your upbringing and kind of the world you grew up in and how you view the lens of the world, but you could have done a bunch of different things. Why'd you decide to start a firm that's focused on what I continue to say is the underserved? I don't know if I'm using that term the right way, but that's why I've always been passionate about knowing you, is leading with serving a community that's been underserved by financial advisors. I think that's amazing. And so why'd you wake up and decide to do it?
Well, Jay, I think as probably you and a lot of folks can relate to or listening to this show, I love the advice industry. And I feel like financial advisors have the best job in helping their clients kind of define where they're at today and get where they want to go in the future. And, starting in this industry right out of college, I've been in this industry my entire career for about 10 years. I worked on the sales side, the wholesaling side of the industry early on for the first kind of half of my career, and worked with thousands of advisory firms. And honestly, Jay, right, the best ones, the advisors just had great EQ. When you talk to them, they're just great people. They weren't the smart. They didn't have to be the smartest. They didn't have to have the best products. So being in the sales, industry, and I just felt like I could do the work. And it was also clear that a lot of the advisors I was working with just weren't. They were all targeting like similar clients. For lack of better words, like your old white retiree. And I thought it was obviously a great segment to target, because that's where most of the money in society lies. But there's a big group of underserved, and a lot of it is unserved folks, right? And then the institutions that serve those people as well. So, starting with Carnegie in the industry and really understanding kind of how to relate to clients and give accessible and relatable advice, it became clear that we could not only kind of like serve my family and friends, right, and deal with the network around me in delivering advice, but also like solve a bigger societal issue, right, and like this wealth disparity that exists by race and by gender. And advice may be the way to do that, right? And obviously, I think advice is one way, right? I love giving advice. I love working with advisors. I like learning new ways to help people achieve their financial objectives. But the other element of that is like policy, right? So I talked a little bit about, right, like our wealth generated for clients is kind of like our impact metric, but it's also a reinforcement that, we know what we're doing as advisors, right? We can help you grow your balance sheet. We can help with investment earnings. We can help you increase the value of your small company, right? And, as we tread forward and generating more wealth for our clients, we feel that those insights can help folks that are not our clients, take action steps to address their own wealth journey, right? But also can potentially influence policy, so that policy decisions are made with more insights relating to how, people that are underserved or unserved by the traditional financial services industry are having success with their finances and, getting ahead toward their goals and objectives and getting ahead in society.
I would say, what's the difference when you think about the difference between the niche you laid out of where most advisors are paying attention to and the unserved or the underserved? Are the needs different? How are you, if someone's listening to this and say, Jason, I couldn't agree more, that I want to play a role in this, and I want to serve and do the best I can to bring my God-given gifts and my hard work ethic to the communities that you're talking about. Are there differences in needs? How do you think about how you're spending your day on the needs of your clients versus maybe a different segment?
Great question, Jay. I think there's one common theme that I'd say exists across our client segments, individuals and families, organizations like foundations and endowments, and startups and small businesses, is that people are ambitious, right? They have ambitions to grow. So I don't quite know if it's necessarily like maybe a racial or gender need outside of like relatability and like shared life experiences so that people feel comfortable with the advice. But I also feel that it's a maybe a generational thing, right? Like a lot of our clients are younger, right? And like they're in growth mode. They're not in distribution mode. So like we don't serve very many retirees or institutions that are spending down, for example. We're serving folks that are in wealth creation mode, right? They need to understand how to best allocate their investments to maximize earnings and profit. They need to understand tax planning, insurance planning, estate planning, right? The institutions that we're working with need to understand how to frame an investment policy, integrate their values into their investment policy, but out earn their spend rate and the rate of inflation, similar to kind of your legacy institution. So I think the planning techniques and the policy setting is very similar, but we're working with clients that are in growth mode and are trying to achieve a better financial future than they currently exist in today. Um,
Right. No, that's fantastic. I was on a podcast earlier this week, and somebody asked me, I thought one of the most interesting things that's happened in the last 6 to 8 weeks, especially in a conversation about race, is Tracy Chapman coming back out, with Fast Car, the song, and retaping it with Luke Combs. And I just said, it doesn't matter what color you are, it doesn't matter what gender you are, it doesn't matter how old you are. You should wake up every morning. Everyone wants to be someone, right? They want to be so much more. They have dreams, they have ambitions. And can we help them as financial advisors, or no matter what you do every day, can we help them get there? Everyone has bigger ambitions than where they are today. And so many people don't know how to get there. And I think it's so cool that you're grabbing an unserved community and you're doing everything you can to give hope to people in a roadmap to get there. So I think it's unbelievably awesome. And I know last time we caught up, and we haven't caught up in quite some time, is you were doing, I think, a venture fund, if that's the right term for what you were doing, and you were looking to raise venture capital to invest in women and minority and people of color led businesses. Is that still going on? And I was just curious to hear how that's gone, and I think the listeners would love to hear what you were up to there.
Absolutely. So I think this is one of the big differentiators of our firm. As we know, the investment industry, particular asset management, is somewhat commoditized, right? We make an asset allocated portfolio. We're allocating to different asset classes. We're hiring fund managers to do that work. But a number of our clients have ambitions or objectives to invest in local, direct kind of impact investments, right? So
Hmm.
think about, a Philadelphia organization, an endowment here that is trying to, focus its grant making in the Philadelphia area, right? And also wants to align some of its investment portfolio to invest in Philadelphia entrepreneurs and projects. Um, we found that, one, we're entrepreneurs. So here in Philadelphia, we're kind of on the ground. We're in this network. So we kind of know we've come across folks. And, as we started to look for these opportunities, we realized that, a lot of entrepreneurs and, folks making real estate projects, one could access maybe a new pool of money to do their projects or their companies and invest in their businesses, but they were lacking the terms, and like the structuring of those rounds in order to pull those investors off the sidelines. What I say about a lot of, institutions really, and I guess like investors in general, are inherently followers, right? Like you're backing
Yeah.
somebody else. So, it's tough to like just like come to like, oh well, we'll raise this amount of money and we'll give you this much equity or ownership or rights or whatever it may be. So having an intermediary to help kind of talk about that with the company, with the investor, has been a nice, niche and space that we found ourselves in serving both kind of small business startups and institutional investors. So over the last 2 years, we've structured about $13 million worth of early stage equity investments on behalf of our clients. We have structured a number of like private credit or debt offerings as well for our clients that have like private credit in their asset allocation and investment policy. We did toy with, fund formation for a second there. So we had a fund, it was called First Market Ventures. It's still in the ecosystem today. We've moved from being in the general partner and kind of the investment manager to being an advisor.
Okay.
And, we're referring investment opportunities to the fund as an advisor, kind of treating it like one of our institutional clients. We got some advice, Jay, I'm sure, and actually I've heard, from podcasts, but also mentors and our board of directors that, mixing the wealth management, the asset management, having proprietary products, right? This is a fine line of like
Yeah.
conflict, kind of, is that option the best one in the market for your client? As a fee only RIA, I think we were starting to toe the line there, and we flirted with this topic a number of times. Be curious about how many firms you see, with proprietary products and how
Yeah,
they.
there aren't many. There aren't many today, and they, like you said, it just skirts the line. And frankly, the bigger issue is if things go sideways, right? You're putting, as our grandmothers probably warned us, don't put all your eggs in one basket. You end up indirectly doing that in some ways, right? Not only for your clients, but as you as the owner of the firm, because now things are just kind of, the fund goes bad, and suddenly your clients are really mad. And so there's just I don't even frankly worry about the conflict as much, because I think as long as it's disclosed, people trust you. Just to me, it's just you're putting too much risk in one place as it relates to your wealth business plus your asset management business. But that's just one person's opinion.
I think that rhymes with a lot of the feedback that we got too, Jay. I also think, I talked about us serving kind of like the organizations, right, endowments and foundations. I think as we approach them to say like, hey, we want to, be your outsourced chief investment officer, OCIO, but also like take a look at this fund that we have. I think we were confusing our selling
Yeah, they're like, "What are you?" Right? Like I
Yeah,
think people want to know who you are. What are you? Right? And when you tell them you're too many things, it's like, wait a minute, what are you really focused on? Who are you, and how do you best serve me? And it just life's complicated enough. People have a hard time differentiating you from the firm down the street. Don't give them another reason to be confused, right?
so
And so I think the last question I wanted, Jason, is congratulations. I don't think we've connected since you were named 40 under 40 by Investment News. It's quite an honor. That's a pretty impressive list every year, and so congratulations on that. And so obviously you're already a leader in the industry, but I always love having guests on. And the question I always end with is, what do you think what's going on in our industry right now that you think people aren't paying enough attention to, right? We read all these articles. To me, they're all the same. It's all the same stuff. Everyone's talking about the same theme. So when I have leaders in the industry on the show like you, I'm always curious to see if there's something you think people aren't paying enough attention to.
absolutely. Well, I think for one, Jay, got to give a shout out to my partner in crime, Chelsea Ransom Cooper, for kicking off that 40 under 40 trend. Hopefully, we see some more of our teammates win that award over time with the 7 advisors, but growing, hopefully. So appreciate that. I think there's a couple trends going on in the industry that I think are definitely worth paying attention to. The first one that I consider is how folks are integrating technology to create a better client or advisor experience. We're seeing companies that are, out here saying that they're creating, the most innovative wealth management technology, right? Building platforms and building, technology mainframes that allow advisors to service more clients and have higher payouts. I think that's really disrupting an industry that's pretty ripe for disruption. I think you look at kind of the legacy technology solutions in the industry today, all of them feeding into the 2 major custodians that control almost all of the assets in the industry. I think there's an interesting chart of like the, technology TAMP and like all the technology CRM providers from like 10 years ago to today, and the list is like 10x, but they all are like on the Schwab platform or the Fidelity platform, right? And
Yeah.
we've seen all these solutions start to cater to like these two main custodians, and I feel like we're going to start to see that unbundling, right? I mean, we are customers of Schwab, but we also are customers of Altruist from a custodial standpoint, and I think we're going to start to see more technology solutions that maybe unbundle the dominance that Schwab and Fidelity have in this industry.
Hmm.
I also think those custodians have the referral programs that are great growth engines for a lot of our peer firms, but make you very reliant on those custodians. And I think as we see that unbundling, we may start to see some of these growth rates in the industry, particularly at the top end of the market, really slow down. I
Yeah.
think technology is a huge trend, and I feel like you could always probably say that. Everybody's probably saying they're building new technology and technology drives innovation, right? I understand that, but it does seem like we're at a point now where there's so much industry dominance and concentration that this is a real thing that can make some real change here in the next couple of years.
No, I
Um,
couldn't agree more. And I think you're going to see the upstarts. We've seen a lot. I spent a number of years at Envestnet when you and I first met, and so have sat there in the seat. I think it's really exciting what's going on, and I think the proliferation. I think it's a positive thing, and I think it's a negative thing. I think the proliferation of so many vendors leaves advisors wanting to be in the technology business instead of wanting to serve clients. And I think they waste a lot of time, trying to be the CTO of the business instead of going out and getting clients. So I do think I'm out there ripping on that part of the industry a lot. So I think it's a double-edged sword. But Jason, we could talk all day, man. Sorry, I know we're running short on time here, but I hope you'd be willing to come back again in the future, because as no surprise, you've been an amazing guest.
well, Jay, appreciate the time here. I'm glad to be a part of it. Thank you for the invitation, and would love to come back anytime.
All right, you're welcome back. You call me anytime.
All right,
Thanks
sounds
everybody
good.
for watching today. A great guest. We're going to have more in the future. Thank you to Investopedia for their partnership. Visit investopedia.com to check out their amazing content. And we'll look forward to seeing you next time on The Deep Dive.